Good afternoon. I'm Roy Weiler, Director of Trading Operations for Time Leverage Capital. For anyone who missed our previous webinars, give us a call at 800-519-9085, and we can send the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so that we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now, for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read and understand all disclosures before investing. All of the examples discussed today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we will do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as Chief Strategist of Dow Jones Megatrends, an all-markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a formal stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Granting Call Options, a Premium Income Strategy and Introduction to Selling Call Options webinar. Mr. Mueller?
Good afternoon. It's great to be with everybody on a beautiful Thursday. Today we'll be following up with what is Module 2, that is Module 2 of the Option Ranger program in the Basic Strategies section. So as a simple reminder, our calculators, the multiple calculators appear so that you can practice trades at your level, so whether you can do an all markets calculation without a visual help, or perhaps you are looking at spreads in the beginning on stocks or futures, you can go to the tutorial calculators that is targeted to that module. Today we will be working in the basic futures module, doing one of the 4 basic trades. Selling a call or granting a call in principle in stocks or in commodities follows the same principles and the same terminologies, although some of the research that you do and some of the particulars that you select in your strike prices will depend on your outlook. Today, let's go ahead and have a quick look at the particulars of the second of the fundamental trades in the series of how to do the basic option strategies. Earlier on, we showed an example using our outlook of a bullish market with an expectation of rising volatility. If you missed that on Tuesday, it may be wise for you to see a rebroadcast or go to our demos, because the trade we will be looking at today is the counterparty trade. So whereas this is buying a call on Tuesday was for somebody who is bullish and has an expectation of rising volatility, today we are going to be looking at the opposite side of that trade, which is somebody who's going to be granting or shorting that call, and this person's expectation, as you can see, is of falling volatility from present levels, and a bearish market. In order to make an informed decision, whether using options or transacting in the instrument directly, it is very important that you have an outlook on both topics, both whether you think the market is going up, down, or sideways, or perhaps you don't have an opinion in that regard, or whether the volatility of the market, again, is going up, rising, falling, or undecided, or you do not have an opinion on it. In order to compile a trade that takes these factors into consideration, you see here some of the classic descriptions of the scenarios when to do such a trade. Today, we are going to be looking at selling or shorting a call and the particulars for doing that. As you can see here, we will go over the particulars of selling a call. Number one, this is a directional trade. It is a direct trade that you do when you have a sense of where the market is going. If you don't have a decent opinion about direction, selling a call is not for you. The second, and this is a narrative description, is to use it when you believe strongly that the market is not going up a lot or will not reach the strike price anytime during the life of the option. So basically this is deciding not so much where the market will go, but rather determining that it won't go into a particular location on a rally, and that is a way of customizing a trade that most people wouldn't know how to do if they only know how to get long or get short. The profit potential when you sell a call is limited to the amount of premium that you collected from the option, and that is the net premium that you've collected, so it has to be what you collect after all your commissions and fees are deducted. This is a margin trade, so unless you are doing a covered call of some sort, then as you can see on the grid, and I'll explain that in a minute, the loss potential is unlimited, and this is a margin trade. Finally, time decay. This trade benefits from time decay because if you are selling an option which has time value, if the market doesn't move into that option, then the time and volatility premium that is in the option will eventually erode. That's why the buyer in option is looking for rising volatility to overcome the time decay, and somebody who sells the option or writes the option is looking for falling volatility in order to benefit from time decay. Now, as you will see here in a moment, we also have a longer narrative of the trade's details that would describe a person who is selling a call. If you look internally at some of the particulars of how this trade is put together and why we use the option ranger, in this particular case you have somebody who sold at a theoretical strike price of 85. So they sold an 85 call, and their expectation and their profit scenario is that as long as the market does not go up to 86, 87, 88, 90, 91, they keep the premium and they make the money. And as long as the market stays below, they benefit. So the benefit of this trade is at 85 or below at expiration. Even if it goes slightly above 85, which is your strike price, as long as it doesn't exceed it by more than the premium collected, you still have some profitability in this area that you can make as you approach expiration. Now, one of the issues, and these are the graphs that have been put up by charts for many years, is as you can see, it's rather counterintuitive to see a line on a graph go down, but to have that grid suggest that it's on prices that go up. This is one of the reasons why we created the option ranger, where the visuals are more intuitive, they're in a spreadsheet, and they are more easily recognizable by the way our brains are wired to do math. Once somebody determines that this is their outlook and they want to say, well, let me test out, I think this market, again, is going to be a market in which there's going to be diminishing volatility and prices will not go up explosively, person goes to one of our basic calculators. In this case, it's going to be the basic futures calculator because we're going to be doing an example on the futures today, and we're going to see how this particular trade works. Now, for purposes of illustration, because this is not individual investment advice, we're really trying to show how options work. We are going to literally take the opposite side of trades that we demonstrated Tuesday during the long call demonstration and take the opposite side of the trade for illustration purposes. So let me go to the first example that we've already saved here, and again, this is for a person that was buying a call. When you click on the trade without having to input the values, the trade already comes up if it's saved, and then you can see an immediate visual reminder of when that outlook is good for this trade. This is a long call, so it's an up directional expectation and an up volatility expectation. So this person bought a call, which it gives him the right but not the obligation to purchase the instrument, in this case the S&P 500 at 1900. And I believe that this position was a June position. The market has moved a little, but we will use the same price and the same illustration to show how the two parties are making opposing bets and that they are based on opposing expectations. And again, as in all cases, one of them will be right and one of them will be wrong. The person who bought this call was looking for the market to explode above 1900 with rising volatility. And then we showed a grid here on a very friendly on the eyes kind of a spreadsheet of what was spent on the option, including commissions and fees at a default, the futures break-even point, the premium break-even point, and the maximum loss if the buyer of this option sits on his hands and waits till expiration for this option to expire worthless. As you can see, the person who bought this call is looking for the higher the run-up, the bigger the volatility, the happier this person is. A flat or a down market is a loser for that particular person. Now, as you will see, and this is easy if you have a tab set up to simulate different trades, you can literally just get rid of the buy a call strategy by clicking on that one spot. You can change it to sell a call. Leave all the inputs the same. So it's still the S&P 500, but instead of somebody betting that the market's going to go up with rising volatility above 1900, this is the other guy who's thinking, no way that this market is going to go above 1900 and overcome all this premium. So they're going to be willing to take that position, take the opposite position, and instead of having the right to buy above at 1900 or above, they have the obligation to sell. And what you see here is a totally upside down flip based on their varying opinions. Now, in this particular case, as you can see, and hold on a second, let me just hit the calculate button on this trade as well. Otherwise the numbers will look the same. And here we go. As you see, everything is totally flipped upside down. Now this person is benefiting and has a big range of profitability, and let's look at it in the box, shall we? So that we go over all of the key elements. First, when we look at the trade, in this particular case, we sold one call option at 1900 for 34 points. The tick value on this contract, as we indicated previously, and is listed in here, is 250 times the index. So you take 34 points times the index, it's 8,500. You subtract the fee that you paid, so the net that would be collected in this particular case is 84.45. It's the net that is collected, and that is the most that can be made on this trade. The break-even point at expiration is that this trader can afford for the futures to expire under 1933.78. At any point under that level, there is some level of gains. And we also have the break-even point on premium, because you want to track the option premium at all times to see where the market is trading. In this particular case, the option premium break-even is at 33.78, meaning that if this trader collects 33.78, which translates to $8,445, and this position goes down to 32.78, pardon the simple math, I'm just trying to illustrate it, then this position will have gained 10 points or $2,500, and they can offset that position on premium and not wait till expiration. By the same token, if the volatility in the S&P were to go up, let's say the market were to hit 1900, and there's all kinds of concern for this particular trader that the market will continue to rally against his directional expectations and with rising volatility, also against the expectations, then they should be looking for an exit. So if instead of if they come out at 43.78 again, then that would be 10 points of premium, and it would be a loss of $2,500. And again, this is a margin trade, as you can see. We're very, very particular about labeling risk and highlighting it in the boldest color, because once we get intrinsically at expiration, let's say we're intrinsically above 1933.78, which is the break-even, every tick above that level would incur a loss of $25, $250 per point on the position. So as we scroll down the line, now you see that there's if you're bearish this market or don't think it's going to run far, there's a sweet spot everywhere from 1900 on down, where this particular person gets to keep the entire premium of 84.45 that was collected. Even if the market rallies above 1900 all the way to its break even, which is at 1933.80 on 78 on the futures, or 33.78 on the premium. Again, even if it rallies above 1900, as you recall, there's a cushion here. And let me point out again, that is similar to this little area here, where the market goes beyond your strike price, beyond your expectation, but not by enough to take back all of the premium that you've collected. So while it is fairly well known that most options expire out of the money, in this case, you can have an option that expires somewhat in the money and yet can still be profitable because the amount collected was greater than the amount that had to be given back, and the specifics intrinsically and both on premium are listed here. If you go back to the original trade, you can see how the two people are making opposite bets. Our initial person was betting on an upside move with rising volatility, and where a flat market or a down market was negative and a big rally made money. And the counterparty to the trade that we just did now, totally opposite bet. As you can see, he's collecting the money. It's all topsy-turvy. This person makes a lot of money in a flat market or down market and loses in a rising market with rising volatility. The utility of the option ranger, again, is that we can go through different instruments. So let's take now the example of the similar trade for somebody who was, and again, we do bullish examples and bearish examples one after the other, because this is not about recommending an outlook. We do have a forum, by the way, where people do post different opinions about the markets, and we can share different trades. But in this particular case, we are really focusing on an illustration. So let's say in this particular case, somebody looks at these contract sizes and says, well, you know, that's a lot of money to make, but if the market breaks out, it's a margin trade, it's a lot of risk. I feel pretty strongly about it. What else can I do? And again, this is what's important about having something that gives you all of the figures and all of the instruments. So now we can go back to the same example, same volatility outlook of somebody who wanted to buy a call but didn't want to spend as much money. Again, when you buy a call, as we indicated previously, your direction is up and your volatility is up. That's not what we're highlighting today, but let's have a quick look anyway. As you see on this particular trade, let's go down the various scenarios here, because it's a smaller contract side. As you can see, it's 1/5. So this person who wanted to buy for whatever purpose, upside volatility, or maybe perhaps it's a long hedge. Again, it's the same 34 ticks, but now it's 1,700 because the tick value and contract size is 50 points instead of 250. So this is a smaller contract, less to be made, less to be lost, depending on whether you're right or wrong. Again, the total outlay here would be 1755, and again at 1755, that is the maximum risk because the person is buying an option. Again, the risk is highlighted in red. The futures break even again is at 1935.1, so at expiration the market would have to be at above 1935.1, which is the strike price plus the premium collected. Or at any time during the transaction. At any time during the transaction, you monitor prices, and if the price is below the if the price is above the 35.1 that the person collected, then they can be in they would be in a profitable trade, and here's the person with his expectation. The bigger the upside move, the bigger the volatility, the more they make. The loss zone, as you can see, is in a flat market or in a down market, which will hurt this position. That would be directionally bullish and bullish on volatility. If we take now the same call again and we just make a simple change so that we can look at the counterparty trade, and we say, well, let's see what it is. Instead of buying a call, what's the other person here thinking that it's selling a call? And you see everything flips again. This person is looking for the market to go down, but also for volatility to go down. And that is a very important distinction in picking direction, because if somebody is just bearish and has no clue about volatility, this may not necessarily be the right trade. And that's why people who trade on direction alone and don't contemplate the importance of volatility are at a disadvantage. They are at an even greater disadvantage when they compete in the marketplace against people who have the flexibility and the knowledge to use options and other instruments. As a reminder, whenever you click on a box, inputs come up on how to input a strike price, on how to input a premium. There's a box for costs, so you always factor in your expenses. And if you want to see a larger spreadsheet, you can expand the output rows to a higher number if it's within the range of your expectations or you want to see, and then you can calculate again. And now again, as we see, totally different scenario, 1/5 of the other. The seller of the call keeps the entire premium as long as the market by expiration finds itself under 19, we have the exact number here, finds itself under the break-even, the futures break-in of 1932.90. They stay below 1932.90. They keep the premium. Or if they can buy back this option for less than 32.90, they have a gain. So again, for ease of math, if they collected 32.90 net and they can get out at 22.90, and again, I'm just shifting the math to make it easy to provide the example. In this case, it would be 10 ticks at $50 a tick. Remember, contract size is 50, so that would be a gain of 500. If they have to pay 10 points more for the position, then it would be a loss of 500. And as you can see here, the range of profitability goes above 1930 intrinsically, and once you get above 1940, it's a margin trade, so the increases go up exponentially. Because these losses are smaller than the contract that's 5 times as big, some people may opt to choose this contract, because even if they have great conviction about the market, they may want to be less exposed to the margin risk, or certainly have less leverage, which would be impacted by a large move as to margin risk and losses. As to gains, again, they are fixed, and they are fixed in what would appear, you would think, as a pretty good range, especially if you're bearish or neutral of the market. Let's continue now with other examples. This was an example on the S&P, and let's go ahead and continue. We did provide some examples on the corn market, so let's go ahead and have a look there. And we actually had a request for somebody who asked about an explosive upside move in the call in the corn, so we input those examples last Tuesday, and this was for a 5 lot. Now again, this is buying options, and then we're going to show the opposite, which is writing options. The buyer of options is expecting an up direction with volatility up. We always have the reminder. And by the way, when you click on this box, if you click on this box, it'll take you straight to this detail on the trade. So you can go back and forth and look at the trades and go directly back to the box. You can go to more contract specs if you need them. You can get a better definition of strike price, because along with the help dialog box with inputs and terminology, you actually have an additional link that is connected right to that dialog box that will take you to some further explanations. I also encourage you to go to our forum to see trades, And needless to say, if you want to email the trade to a friend for an opinion, you want to print it out for comparison, you want to save it under a tab that you can name yourself, or you want to post it to the forum, you can do all that. So now that we've looked at the long call, for time decay, this is in the case of a person who wanted to buy 5 480 calls. They were expensive. And by the way, just out of curiosity, what are those the 480 calls worth today? We're looking at the I think we're looking at the December 14 calls. We're going to get on price on those in a minute, because I do want to see how the movement in the last couple of days with rising volatility may give you a quick illustration how it may have impacted these prices.
They're at 46.
Okay, so again, no big deal. They gained 2 points on a move today in the market. So they did gain a couple of ticks against what was input previously. So that trade today would be up $100 per position gross on a 5-lot, assuming you could get those fills. And of course, you have to deduct your costs, and that's where you go to your premium break even. Your premium break even, you could do the math today, is 45.1. So let's say 45 for ease of math. So somebody'd say, well, I made $50 in 2 days on a position. Is that really worth it to me, or do I want to hang in? Again, if the person continues to expect a rally with rising volatility, they're in the trade they want. But let's say somebody else at the same time said, you know what, no way this rally is going to sustain, for whatever reasons they may have. So they might turn around and say, well, you know what I'm going to do? I'm going to sell a call. Hold on a second. Just a moment. Just a moment. Let's go ahead and reset this trade. Okay, contract market. Okay, let's go to corn. And let's go ahead and sell the call. And now we're going to calculate, because it's a different trade. All these dialog menus items are the same, but now we get a totally flipped picture. Now this person is looking for direction to be down and for volatility to be down, totally the opposite of the guy who bought the call. This is an opposite outlook. It's the counterparty to the trade. I'm not going to change prices again, because it's really an illustration to see how now this trade is entirely upside, is opposite. The person who's betting the market won't go up, that is going to go down with falling volatility, or at least not get to the strike price, has a cushion. It's a large position. They have this is a 5-lot, so on this particular position, the person had an net outlay of 10,700. A net collection of 10,725. If the future stays below 522.9 at expiration, this trade is still a winner. And again, if you're looking, again, it's different prices today, but as of today, the market is at, we are looking at what month? Just a moment. That's December. So we are looking at what prices in the December corn? Just a moment. I'm going to pull up, I think they're settled out, so we should be able to have a price. We're looking at $489.25 on the settlement. $489.25. So again, if this person, if today were expiration day with time erosion at $489.25, this person would still be picking up money, although the 480 calls have gone intrinsically, although the 480 calls are in the money 9 cents. So as you can see, time erosion indeed would benefit this trade if it just stayed where it was and time passed, instead of this person being down 2 cents on the transaction plus transaction cost at expiration, would end up being up over $8,000. So time erosion, as we all know, is a very powerful force. It is a reality of nature. It is a reality of life. And it is something that option writers, when the premiums are high, take into account, and that's exactly what writing a call is. As you can see here, we're talking direction, we're talking volatility down, but primarily we're also talking about the power of time decay. In the case of writing calls, there's one very close companion trade to writing calls, and it's certainly one of the reasons that we're doing the examples of writing a call today in the context of a hedger. If somebody owns a stock or a commodity or some other underlying instrument, they can sell a covered call, which is a call like this, and instead of that call being naked with unlimited risk, those calls would be covered. So in this case, if the seller of these calls were a farmer who had 25,000 bushels of corn, then essentially these calls would not be naked because he owns the underlying instrument and he's just collecting the additional money in order to preset an exit and perhaps have some additional premium income. The same is true for a stock person. If somebody were to write a call not to speculate, but in order to generate premium income against the portfolio, then these calls would be a covered call and they would have a very different scenario from a strictly speculative short naked call. So these are two different scenarios. As we indicated in our last webinar in our poll, it is very important to know whether you are adding a call, you are selling a call for purposes of covering something or determining an exit, or strictly for a speculative premium income transaction. I want to also point you out to our reference materials, if I may, and as you will see here, we have, in addition to option sheets with definitions, we have an extensive demo video library. And again, just for purposes of today, the way trades are input and the way the software works for modeling trades, you can go directly there and you can go to multiple demos. So for instance, right here we would have the demo that corresponds to today's trade, which is a demonstration of selling a call in the soybean market. And when you go ahead and click on the video, you'll be taken through a complete example of how to input a trade, how to enter a strike price, how to enter the premium, and how to change the values so you can model out and test out different trades. If you have further questions, remember you can go to the frequently asked questions section and as well as to our forum to ask questions, or you can go to our FAQ section where you will get a number of the features that are available and how you can use the software along with some of the basic questions that people ask. If you are part of the beta group, be sure to get your own username and password so that we can populate your tabs with the trades that make sense to you. What you want to do is have your own home page where you have saved trades, either that you saved or that somebody you work with saved for you, so you can keep doing what we're doing. Compare different trades, look at different strike prices, compare different spreadsheets, update values as you go, as well as create your own tabs for trades that you look at longer term. All current calculations, once you input a trade and hit calculate, all those calculations will appear on the left tab, so you can go back to them anytime. They're labeled and they're dated. If there are trades that you want to follow longer term, then you can save them to one of these tabs, and they'll be dated under that tab, and you can name the tab for the particular market or the particular type of strategy that you are monitoring. And it's self-explanatory, but again, after you set up the tabs, we can work with you to set up a few initial tabs to work with, and then going through the demo videos and working with the coach, you'll be able to establish all of these different spreadsheets, which they will generate automatically all of the transitions from premium values to dollars and cents, along with the intrinsic profit and loss scenario on the trade. So what we have found, again, in number one, in demonstrating the trades in this counterparty manner, where we show that what's the buyer of the call, what's the seller of a call, their opposing expectations, it gives a better perspective on who's making money and what their expectations are. Tomorrow we're going to do a program in which we're going to update on our master calculator some of the trades that we've been following, and also some of the hottest markets that people are always asking about, We're going to be having a look at the S&P, always a topic of great interest. We're going to look at crude oil, which may have bottomed out today, perhaps, and also the grain market, which has been extraordinarily volatile. We're also seeing some movement in the interest rates and might start modeling some new transactions, some inflation-minded or bond change transactions as well, because we're getting some requests for those. Any questions or comments?
Not today, no.
Okay, well, that's outstanding. Thank you all for attending, and again, we are very pleased that the people who take the time, who use the software and set up their tabs, are showing terrific improvement in their understanding of trades and in their comfort level in selecting what is and is not suitable for them by understanding the risks and rewards. So we're very pleased with the results so far. Please continue at it, and you will see the results as well, again, based on your pace and based on your starting level. Congratulations for participating, and we're at your service to help you trade better.
Thank you.